we'll get started then. For those people that are new to the platform, welcome. Elevate is now one of the largest platforms for finance and investing careers. We started this about a year ago as a way to connect really the students and early professionals with experienced professionals and firms to dive into more resources around careers, around training, around mentorship, around recruiting and networking, and so on and so forth. So in the last year, now partnered up with over 100 student clubs across the top 35 or 40 universities, as well as the top 10 MBA programs. So kind of very proud of that growth, as well as being able to have on amazing speakers like Milwood that we'll have on today. So without further ado, look out for things from Elevate. Our next big event is we're having an India investing panel at the end of this month, focused on Southeast Asia and India. So we'll have on folks from Warburg, GA, Sequoia, and a bunch of stuff. We're going to do PE, VC, and growth equity in that session. So you guys will get more information about that. And then I'll share with you some more info on Elevate on the chat. So without further ado, Milwood, welcome to the platform.
Hey, thanks for having me.
You're welcome.
Hi, everyone. For those I see, hello. For those I know, Sophia, good to see you. So looking forward to it.
Excellent. So I was going to give your whole bio, but I felt like I would love for you to go through, and he's done.
You're trying to say it's long because I'm old. Is that what you're saying?
No. As long as you've done a lot. So I think I would turn over to you if you want to give the group, and just to give you an understanding, we'll probably have at the end of this probably over 100 people from your undergrad side, as well as MBAs, as well as in the middle, right? So anyone in that early part of their career thinking about or interested or already going into careers in private equity, investing, venture, investment banking, so on and so forth. So that's kind of the broad array of our audience here.
Good. Well, look, I've kind of over my career been in all facets of banking, so happy to give you my story, and certainly want to hear from you. This is your time, so please don't be shy and don't be afraid to step up to the mic. So look, I'm Southern by nature, which just means I've been able to survive 20 years on Wall Street, being a Southern guy. So there's hope for all of us. I started out my career at Nations Bank, which is now B of A, and I was the youngest controller at the bank, and was controller for leveraged finance. And one thing about being a controller and accountant to a group like leveraged finance is I was like, wow, I want to be a leveraged finance banker. So I had some, the way I work is if I have a question, I ask. There's really no reason not to ask your questions. So I asked the head of leveraged finance. I said, hey, can I move down to leveraged finance? And I was 24 years old, and he said, you could definitely become an analyst, but Milwood, you really should, first of all, you're just an accountant. You should really get some sales experience, and you should go get an MBA, and then you should go on Wall Street. So again, I'm very good at following orders. So I quit. I went to GE Capital. I did sales for like 1 year to the day. And the reason why I left was I was 25. I had a Ford Taurus, which you guys don't even know that car, but that car was like a really nice car back then. I had a sunroof, and I was making about $100 grand a year at 25. And I said, if I don't go back to school now, I'm never going to go back to school. So I quit and went to Columbia Business School with the goal of being a left-hand banker. Fast forward, I spent my summer at First Boston in leveraged finance and in asset backs, and joined Deutsche Bank as a leveraged finance banker. Spent 7 years at Deutsche Bank, then went to Goldman Sachs, did leveraged finance there, switched to high yield sales there. So I've also been in sales and trading, and joined Oaktree about 8 years ago. And today I run originations, which means I source structured private credit deals for all of Oaktree, which we manage about 140 billion. So I've got a team that sort of is out there and helping me originate structured private credit deals. So that's a little bit on my career. Happy to delve into more or less, but I've stayed in nice hotels, I've flown private, blah 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 blah. So I've lived it all in my 20 years.
Excellent. I think we will have a lot to dive into here.
Great.
I think as we go through this, but let's start kind of most recent backwards. Can you talk a little about, obviously 8 years at Oaktree and now a leadership role? What makes Oaktree unique to you, and kind of what has been, the thing that's kept you there? And then how do you talk about the business to people as far as, and a great place to be? Obviously outside in, we know it's an amazing place, but kind of inside out, what has been your experience?
Yeah, so look, I mean, Wall Street's a funny place, generally speaking. And I think where the confusion or mystery lies is you always want to be at what you think the best firm is, right? You want to be at, the highest ranking firm or the leader in that. The reality is you really want to be where you can be you, and they're accepting of who you are, and then you're given more opportunity to be more and more successful. So I think the one good thing about Oaktree is an environment where I can be Milwood, and I don't feel like I need to be anybody else. And that comfort allows you to, what I say, stretch and participate and do things that you wouldn't ordinarily do if you were uncomfortable, right? If you're at an environment or if you're at a firm that you're not really comfortable, but you feel like it's a great brand, it's a great name, or that group is great, it's much harder to be successful. So I think number one is it's a culture where I can be me. Number two is capital is a bit of the commodity, right? Just because we manage $140 billion, Apollo manages a lot, TPG manages a lot, Blackstone manages a lot. There's really no differentiation in saying you manage $140 billion. Where the differentiation comes is how do you transact, and and this is a people business. I mean, I don't care what anyone says. Capital is the commodity. Wall Street's a people business. And so I think what makes Oaktree successful is that we manage relationships. We don't manage capital in the sense of when I'm talking to the CEO or CFO of a business, I want them to do business with Oaktree because he says, you know what, really like talking to that guy, great guy. And if things go sideways, I feel comfortable calling Milwood in the middle of the night saying, this is what's going on. If there's no comfort, I think it's harder to transact. And so we've been in credit since '95. We're the world's largest distressed fund. We know credit. We price risk. So in a market like today, where really the risk is being priced based on supply, demand, of capital, it's a much harder environment to put money to work, especially for a firm that we're sort of waiting for a dislocation, right? We're waiting for where we can actually price the risk and then sometimes get a premium to that price because no one else is putting money to work. So hopefully that answers the question.
Yeah, no, that's great. I think I want to dive to that kind of the investing theme in a second. First of all, to the aside to all the investment bankers, junior people, Milwood says his clients call him at the middle of the night. So it's you got to like your job, right? So whether it's your MD,
you gotta like it. You gotta like it. Look, by the way, like if money's not one of three reasons why you go to Wall Street, then but you only get paid one time in the year, right? Your bonus comes one day. You can take a picture of it, you can print it off, you can look at it a few times. You really gotta like what you do, because for the other 364 days, you gotta really like it. And so you gotta be passionate about finance, because it's very hard to be in a profession like investment banking, like sales and trading, like asset management, if you don't really like it. You won't last.
Yeah, no, great point. And exactly. I think the only addendum to that is that you got to like it, because you got to be willing to do that extra 30, 40, 50%. And the only reason you're going to do that is because you care about your job and you actually like what you do. So I 100% agreement. So Will, for the people that are a little bit more, new, like in college, for instance,
yeah,
dive in a little bit of when what you mean by the credit investing side, the distressed investing side, and kind of the actual nature of the types of work that you do at Oaktree.
Yeah, so I'm gonna start even more basic than that. I'm gonna talk about just Wall Street, Main Street, right? So your parents invest in retirement money, right? So they got to retire, so they put away $100 a month, and they designate a yield they want, a return, right? And they say, you know what? I'm retiring in 20 years. I want to earn 8% of my money. So they put the $100 with Fidelity, right? Fidelity calls Goldman Sachs, Deutsche Bank, and they call the sales and trading desk, and they said, hey, I just got $100. I need to find investments that will yield me 6 or 8%. So the investment bank then on the sales and trading side calls the capital markets person and says, hey, I got $100. I need to invest it in 6 to 8%. Do you know any companies where I can invest in 6 to 8%? Now I'm simplifying the process just so you get the circle of life, if you will. So then the cap market says, you know what, let me call the investment banker. Hey, investment banker, do you know any of your clients who need $100 and have projects they have, and it could be M&A, it could be CapEx, it could be whatever, where I can put this $100 and get back 6 to 8%. The company then says, oh, that's great, because your parent who gave me the $100 actually bought my product on the other side. And so now because they buy my product, I've got revenue, and now I want to grow. So yeah, I can use that $100. And so the point is like, it's all one big circle. The products you buy end up driving the return that your parents want to achieve on the other side. And so the point of that is that in the world of investment banking is about products and services that companies need or want because of growth, expansion, what have you, which is driven by the very dollars you use. And that's why consumers drive 75% of GDP. It's all one circle. So hopefully that gives you a little bit of a basic background on how Wall Street sort of operates. Happy to take any of those segments or sectors and go through it in more detail, but just thought I'd lay that out as a foundation.
No, that's super helpful. And then as it relates to Oaktree, obviously you guys are the leading, distressed and credit investor space. So maybe give people just a 30-second primer on what credit and distressed investing is and how you guys look at it.
Yeah. So let's take the same $100, right? And company X says, yeah, I need $100 to build a plant because all your parents are buying all my product and I need to grow. And so what will happen is twofold. One is that capital markets or that sell side firm reaches out to us and says, hey, you guys have a bucket of capital that can invest in 6 to 8%. Here's company XYZ. Will you invest? And so where we spend our time is we analyze companies and we make investments in those companies, credit investments, and our return and our strategies is driven by the risk of the investment. So if it's not that risky, we may be 4, 5, 6%. If it's risky and distressed, it could be 20+%. And companies, because of leverage, being over leveraged, because of mismanagement, can go from being great companies to being what I call stress or distress. And so what we try to do is we try to capitalize on how do we invest all across the company cycle? How do we invest when they're good times? How do we invest when they're stressed? How do we invest when they're about to file bankruptcy? How do we invest coming out of the bankruptcy and starting it all over again? And so our job is to analyze the risk, make a judgment on that risk, and invest dollars that have been given to us by the very pension or endowments that are affiliated with, frankly, your parents.
Got it. And then I love that explanation. I think a lot of people,
do you really love it?
I like it because it simplifies it, right? So let me okay, I'll get to, well, then you can offline call me. But I think, my point is, like, let's go into the credit. So what makes a good credit investor? You've been in this kind of space for 8 years, right? Yep. What do you think, what differentiates, and how, as an investor, like as a young professional, et cetera, how do you start developing that sort of, critical mindset?
Okay. So we talked about passion, right? You got to really want to do this. There's some books, and I'm happy to give you the books that I think are great foundational finance and accounting that I think are the foundation for the technical skills necessary to be an investor, right? And so at the end we can go through the books, but the reality of it is the way what we do is we take a company's financials, right, and we assess effectively the financial health of that business. And so let's say XYZ calls me and says, I have XYZ deal. Can you look at it? We say, great. We look at the financials and we say, yeah, that's interesting. Now I need to talk to management, right? So I schedule a call with the management team and I kind of hear their story and I ask questions along the way. Because in leverage finance, management kind of drives, whether my return makes it or not. Because what a leverage finance company is typically a company that's non-investment grade, that has a riskier cash flow profile. And thus any sort of misstep means they can't service my debt, right? And then all of a sudden they're over levered, and then they're bankrupt. And so after a management meeting, we then huddle, we discuss the credit. We discuss the merits of the investment. We talk about why we should or should not be investing. And then we make a decision. And then we decide how much we want to invest. And that decision is based on size of the company, size of the investment, size of our funds. And then the diversification element of it is, we don't want, if we only have $100, we don't want to put $20 in one firm, because if that firm blows up and I lose $20, I'm going to lose the other 80 because my clients like you suck. So we may only, of our $100, put $5 in that one company, just so we stay diversified. Does that make sense?
Yep. No, that makes sense. You kind of take the top down approach. Is it a good investment? Oh yeah. You take that top. Is it a good investment overall? Should we be in it? And then let's decide kind of what the pricing is and kind of what that makes a lot of sense. Yep. I also like how you think about the whole cycle. So you may say, hey, this is not necessarily a good growth investment, but let's see what happens in the next 6 months and see how they actually perform, and maybe it becomes a credit investment in some sense, right?
Yeah. So we will do good point. So we invest in what I call technology businesses on a recurring revenue basis. Do you understand what recurring revenue means?
Yep.
So basically, tech companies are really interesting because they sign up, like Zoom. They sign up members and they charge members a monthly fee. So they charge you a license fee and a monthly fee per user. Like, that's a form of recurring revenue. So the business may not have a lot of cash flow because it's growing. We will lend on that growth, and we will lend on a multiple of recurring revenue. And so we will make those investments, which are very different than the industrial company that's building a plant that I'm secured by the assets of that business. That's a different investment, but we do both of those investments at Oaktree. We do those spectrums.
Got it. I want to spend a minute, Anthony, we'll get to you in a second. I want to spend a minute on Milwood, like the evolution of the credit markets, right? That we've seen in the last, since the global financial crisis, to an extent, how there's sort of an explosion of alternative sources of credit like yourself, BDCs and unitranche and things like that. So maybe help us understand what you think led to that and where we are in that kind of credit cycle.
Yeah, so good question. So in 2007, I was at Deutsche Bank, and I had just structured Nuveen, First Data, US Foods, Ceridian, and a bunch of LBOs. Back in 2007, the risk of the sort of financial markets was tied up in 7 or 8 firms, right? 7 or 8 firms were the majority of risk takers when a company bought another business or did a capital plan. It was very concentrated. What Dodd-Frank, and so when it crashed, and by the way, that concentration only got more because they levered their balance sheets. So if you look at JP Morgan, Bear Stearns, all these, they were levered 30-1 on their balance sheets, and they lent that to potential LBOs and leverage financings. And that when that market crashed, the legislation, they created what was called Dodd-Frank, and they said basically banks were going to manage that risk going forward because it created systematic risks in the banking system. And so what happened is, once Dodd-Frank came out, the banks could no longer underwrite those high risk, highly levered deals. And so that activity had to go somewhere, right? And so then you had the evolution of private credit firms and asset managers like us, who basically are now taking on that part of the lending process and activity. And that's been the growth of private credit. And that's been the growth of, how these deals have gotten done. Now, the banks still do it, but they don't do it to the extent they were doing in 2007. So that gives you some background on it.
Yeah, no, that's super helpful. So presumably, the last 8 years or 10 years, the market's grown in private credit, but so is competition. So how do you think about the skills that, are you forced to become more of an operator as well as a transactor? You mentioned capital is a commodity, right? So yeah, things you think in a more crowded space that makes you successful at Oaktree?
Yeah, so look, and no different than any credit firm out there. We're in the storage business, right? So it's different than the moving business. The investment banks are in the moving business. They need to package it so that they can sell it and move on, right? And so that's a different sort of process and activity. Once I own it, I own it. And so if you sold me a TV and there's center blocks in there and not a TV, it's my problem. And so you got to make sure, because you're owning the risk, you've got to really evaluate it from an ownership perspective versus marketing the risk to then sell it to someone who's going to own it. It's like the realtor, right? The real estate agent is packaging the house to sell it. And it's my job to make sure my inspection and everything else works out, because if I buy the house and it's not properly inspected or there's mold, my investment's automatically going to be worth less. So
right. Kind of the diligence aspect and the ownership mindset, right, as an investor versus sort of an advisor, right, when you're at an investment bank, is really important. I think that also affects the nature of the work, right? You're digging in, you're saying, all right, I got to own this in the next X amount of years. How do I get comfortable with it? That makes a lot of sense. And then I guess from that sense, right, like given where we are, I know we're not in the business of predicting, but I think we had a dislocation just about a year ago right now, right? And then kind of a great time to be a credit investor and also help companies have access to capital when they otherwise haven't. And then last year we've seen sort of this rebound. So maybe from your perspective, I guess there's two questions there. One is, across different parts of the cycle, how do you guys think about investing? And then sort of where we are now, where things seem pricey, but there's some like dislocation in a mindset. Like, how do you think about where we are in the broader cycle?
Look, I think investors pay firms like ours to put money to work in a judicious manner, right? And so you have to, for the benefit of your clients, you have to be invested. What you do in these sort of markets, where to your point, if it appears like credit's too tight or there's too much capital chasing investments, you tend to then say, okay, how do I shift my strategy to maybe I'm not in the middle of the fairway, maybe I'm just on the fringe of the fairway, still get a good lie, but it's not as crowded. And so we try to find opportunities where for whatever reason, it's not as crowded. Like we may invest in businesses that are coming out of a cycle, whereas somebody else may say, you know what, I only want to invest in a business that I know is not in a cycle. So we tend to then put on a more technical approach or hat to how we think about risk. And I think in this market, you just have to be very prudent around what you're pricing. And there's an element of it that says, in today's market, to my point earlier, you're not necessarily pricing the risk because there's so much capital chasing that opportunity. So that 6 to 8% opportunity I mentioned in the beginning, that opportunity, because so much capital is chasing, may actually price at 4 to 6, right? And so I got to say to myself, do I want to take the 4 to 6% return, or do I feel like a cycle could make that 4 to 6% look like 12 and I lose money? So you just got to be more judicious around your capital deployment in markets like this.
No, that makes sense. A kind of addendum to that on the investing side, staying there. Obviously, Howard just wrote a memo on value versus growth, and historically, his mindset, your all mindsets, has been a little more value. Obviously, you've done so well, but having seen the rise in sort of these high multiple, high valued companies in the last 3 to 5 years, maybe you can, tell us or tell the audience a little bit about, how that's impacting your mindset on growth companies, valuations versus sort of the value side of kind of buying things at a more reasonable price.
Yeah. So look, I think you have to be cognizant that the Fed has really put a lot of capital in the market, right? And it sort of made it. I'm not going to say it's like if you had back pain and you took Vicodin, you don't feel it anymore. But it's made the market a little less connected to the underlying fundamentals, because there's a psychology that the Fed and stimulus will backstop any sort of disconnection in the market. And the issue with the March-April dislocation was that it was very short, and now stocks, bonds, credit trade tighter than they did, or higher, depending on which instrument, than they did pre-COVID, right? And so you have to say to yourself, well, maybe there's a downturn, but the last downturn didn't last that long, so maybe I shouldn't worry about the next downturn, right? Because the Fed's going to. So there's this mindset of, why shouldn't I invest if it only lasts 30 or 40 days? Okay, so the next one will last 30 or 40 days. The problem is that the psychology, the very same psychology that convinced you to do that, is the same psychology that will convince you to sell when the market's going down. So, I think it's just human psychology. And I think for, a lot of firms, you have to sort of, you try to manage that risk, you try to hedge it, you try to do things so that you can, instead of being up and down, you sort of smooth out the returns, right? And so I think one thing we're probably pretty good at is just trying to see around the corner, right? How do you see what's happening in the underlying businesses, and how do you translate that into what may happen in the future, and how are you positioning yourself today so that when that happens, you're not nicked.
Yeah, no, yeah, that's a great point. You have to underline, back to your original point, you got to want to own the underlying business, right? Like Buffett said this, all these guys,
Correct.
Howard
Correct.
said, you're saying this, like, irrespective of price, you got to want to own it and have to see it.
Yeah. If you liked it at par, you got to love it at 50. And if you love it at 50, you got to want to you're Google Gaga when it gets 25, right? So if you fundamentally believe it's par, and the only reason why it's going from par to 50 is the liquidity of that security and not the underlying business performance, you should buy that all day long, because that's a temporary dislocation.
Yep.
And that's the other thing that Dodd-Frank did. It changed the liquidity. ETFs, Dodd-Frank, it's changing the liquidity of the market and changing the volatility of the market.
Yeah, great points. I related to this, we had a audience questions come in, so we're going to pepper them in through. And you guys, if you want to ask, you can either message us here or DM us on IG. But Anthony Resnick, if you want to kind of step up and ask your question.
Thanks, and thanks, Milwood, for being here. You kind of touched upon it with a couple of your sentences earlier about like investing right now, because in a distressed environment, because the Fed can come and bail everything out, and boom, you just made return on your money. But I consider that to be kind of foolish. Mm-hmm. My question is the rise of zombie companies on the U.S. stock exchange. And in that regard, how does Oaktree see themselves with their strategy when looking at these potentially distressed scenarios, that all in like what I would call an artificially low interest rate environment? How do you guys look at that in terms from a macroeconomic standpoint?
So when you say zombie, are you talking about companies that are distressed, or are you talking about like describe zombie?
Zombie companies, I think they're defined as like a company that needs a bailout in order to operate. Okay. Like they're so indebted that they can't generate.
Stress, right. And so good question. So what we try to do is right now in this market, what the Fed and others are doing is they're giving life to these, what you would call zombie companies, right? And so what they're doing is they're kicking the can down the road. And as long as they have access to capital, there's no aha moment, or there's no sort of moment where the reckoning happens, right? It's just delaying the inevitable. And so what you have to do is, and sometimes that's good. Sometimes, like a GameStop, or AMC, where that sort of price, movement in their stocks, the sort of CFO hat would say, I should issue stock and make my balance sheet better so that I can weather the downturn when if that happens, right? And so what you're able to do in this market is companies are able to take advantage of access to capital to put on their balance sheet to survive another day, which is why the distress cycle is being effectively delayed or not happening, depending on your take on it.
I think just a lot of patience is going to be required.
A lot of patience. You've got to, there are companies out there that, like Hertz, right? Hertz Hertz was an entity that was impacted by the movement of Uber, right? And so the majority of their business was on airport locations, whereas Enterprise is off airport. On airport, 5 years ago, 6 years ago, was suffering because of the demand that Uber put on that business. And so it's sort of been languishing for a while. And then once business travel went away, it just collapsed, right? And so inevitable, to your point, Anthony, if you're patient, if you believe in market efficiency, at some point that reckoning should happen.
Yep, a good question, Anthony. By the way, anyone who's asking questions, feel free to introduce kind of who you're from or what your background is if you'd like.
Yeah, tell me where you're in school at, where you live in.
Yeah, I could definitely tell you real quick. I'm a sophomore at Georgetown University, and I'm currently semestering in Arlington, Virginia, with a couple of my best friends, even though I'm a native from Los Angeles.
McDonough, you're at McDonough School of Business?
Correct. Yep.
Yeah.
Good stuff.
We have a good amount of folks from Georgetown across Elevate and across the whole thing. So let's keep going. Milwood, I'm going to take a little offshoot and look at a couple more questions here. Ryan Pitt-Savage, if you want to ask your question.
Sure, thanks. Ryan Pitt-Savage, CBS as well. So good to see you on the chat here. I'm going my first year MBA, doing a little bit of a career switch from being on the technology side at Bloomberg in private equity to moving into private credit markets. So had a question. I know this comes up pretty much every year, but especially during the pandemic, how do you feel about the market in private credit and direct lending? Do you feel that it's become oversaturated? And if not, do you think it's still going to continue to grow with potential new distressed companies coming out of the pandemic?
Yeah, so great question. It's something that you debate almost daily, right? So if you think about private credit, because it's private, any loan out there, that bilateral agreement with the company and whoever that private credit institution is, they can kick the can as long as they want, right? They can delay the inevitable. They're the only investor. It's a private deal, and so there is that sort of, is there the activity of just delaying, entities that are going to, eventually falter. The other point is there are a lot of new private credit platforms. Well, what do you think if you're a new private credit platform and you need to put money to work? What do you think ends up happening? More than likely, you end up doing the deal that all the big guys passed on because they see a lot of opportunities and they don't have to do that deal. So if there are 200 new private credit companies out there, private credit funds, there is a possibility that there are 200 bad deals out there, right? And when I say bad, it could be mispriced, it could be over-levered, or it just could be a bad business, right? And so there in itself creates a pipeline of potential restructurings, if you will. So, but as long as money is cheap and as long as it's plentiful, you can delay that process for some period of time. And that's a little bit what could be going on today. Brian, did I answer your question, by the way? Because I just want to make sure, you're a Columbia guy and you're in the middle of my screen. So I just want to make sure you're happy.
No, that definitely answered. I guess one little maybe addendum to that. Do you think that there'll be a shift to, as maybe credit gets a little bit more expensive, that institutional will take a little bit bigger bite than private credit has recently?
So you're seeing that now. So because of the success in March and April of the coming out of that, and you're seeing the investment banks be more aggressive about underwriting and distributing that risk. And in a lot of times beating out what private credit is going to offer them. So private credit allows certainty of execution. It can be much faster than a public process. But in the current market, I would say the banks are cheaper. Their indicative rates are cheaper than the rates we would quote in private credit. And if I'm a company, I'd rather go with the indicative rate if the market's that robust, because more than likely, and when I say indicative, let's say XYZ company is getting quoted from a bank 4.5%. And I say I do that deal at 6%. They're going to go down the bank route because there's enough cushion there and the market being robust, more than likely, even if it's not an easy deal, it may still get done at 5. And so the investment banks are definitely being more aggressive about underwriting the risk in a market where it's easier to distribute because of capital.
Yeah, that's a great point on the supply demand side. Thanks, Ryan. We had to get a Columbia CBS person in. Jason, we'll go to you next. Jason Thomas. Hey,
Jason.
How are you? Thank you for talking to us. I'm currently a freshman at Rutgers Business School, New Brunswick. So yeah, I saw you went there. Glad to see that. So my question is, I was reading about distressed debt and your approach to it at Oaktree. So I was wondering, when you're investing in a company that's distressed and you look to like make your money in terms of adding value when the firm has to restructure, how do you approach doing that? And like, what kind of things do you think about?
So look, and it's not every distressed situation turns out great, right? But what you're thinking about generally when you think about why did a company become distressed? A couple things. One, either their margins got compressed because there was more competition, right? And management or for whatever reason couldn't react to that, and their financials were crushed. They could just be over levered and have a bad balance sheet. And so if they restructure or reorganize, they're much better off and their balance sheet's cleaner and they're on their way. And so every distress situation is different as to what drove them into that situation and how do you get out of it. And I think what we're trying to do, and what any firm is trying to do in that, is figure out, is this something that is just a bad balance sheet that if you fix it, the business can continue? Or is there a structural decline in that industry or that business that causes it to give you pause in terms of whether or not you want to be involved in that business, right? There's some distressed businesses that may not make it. And so that may not be a good investment opportunity for us or for anyone who does distress. But what you're trying to do is analyze the coming out. Like what does it look like? Is there pension liabilities? Do they get cleaned up? Is it in just a bad business? Does it have too many plants and thus too inefficient? How do you fix that? There are a lot of different reasons, and that's why that's a complicated investing strategy. So kudos to you for spending time on it. But each situation is different. And all we're ultimately trying to do is presumably we figured out where we think value breaks in that business, right? And so the strategy is, did you invest in the security where it's considered the fulcrum, right? And when it comes out of that cycle, are you in the best, position to capitalize on a restructured entity?
Awesome. Good question, Jason. Actually, that's a pretty good question. Rutgers in the house. So let's keep going. Chris Fuentes, did you still have a question, or should we keep it moving? I know you.
My question actually got answered, but
you can do your intro if you want.
What's your background, Chris?
Yeah, so I'm a third year right now at the University of Florida. Again, last summer I actually worked with Adams Street Partners, so I've been pretty deep in the private credit scene. Will Sapp, yeah, yeah. Yeah, no, it's been a great experience. Definitely an area I'm interested in. This summer I'm going to be at Lazard in the New York office, hopefully. So.
Well, great, good, congrats.
Thanks, Chris. Let's keep going. Pranjal from Chicago booth. I think you had a question.
Hi, Milwood, and thank you, Kaushik, for having us over here.
Sure.
I am a dual master across Chicago booth in Penn Law, doing an MBA and a master in law. And for the summer, I will be in Vancouver at British Columbia Investment Management in the direct PE team as a summer principal. My question is more on the trade-offs you're making currently, because as one of the prior questions was on the side of the saturation in the credit market and the relaxation of the norms. I presume now having the downside protections are much more tougher due to the laxity of the governance. So how do you make your own trade-offs of continuing to invest? Because at the end of the day, you have to deploy to some extent to keep the business going on too. So just curious to know how, senior people think in the industry of the trade-offs, what's happening in the dynamics and continuing to grow their AUM.
Yeah, look, I think in just in the DNA, the way some firms are set up is that you are inevitably position yourself to manage through a cycle, right? So if you invest a lot in March and April, you're spending time now harvesting those investments because they've all paid off, right? So you may have over invested in March and April, and now you've sort of, you know, cycled out of it, and you may be fully invested today, but you've locked in gains, so you don't necessarily need to sell a security because you've kind of got an embedded gain in that, and so you can wait a little while longer and stay invested. I think every firm probably thinks about it differently in terms of their risk management strategies. I think what we're trying to do is avoid losers, as Howard would tell you. Avoid the losers, the winners will take care of themselves. And so, you know, we like the private credit space because it's bespoke. It's a little bit more off the run. You can shape your structure a little bit more. The documentation can be a little bit better. But we play in public deals because we've got open-end accounts, and you know, we're targeting a certain yield, and so we'll play. But those tend to be larger companies for us, much larger cap structures, much bigger businesses, and so there's a little bit of an insulation just given the size and scope of that business. Where you can go sideways is if you're doing private deals in small companies or public deals in businesses that may or may not exist in the future. And so that's where you're trying to avoid those situations. But you know, it's our job to find the right investment strategy and opportunities for our clients, and that's what we spend our time doing.
Awesome, thanks. Good question, Pranjal. Thanks, Milwood. A ton of questions. So we'll try to get as many as possible with Milwood's time. Be respectful. Grant Schwartz from Harvard, you're next.
Yeah, so first, thank you so much. I mean, hearing your speak has been amazing. And I've been a big follower of, you know, Oaktree and Howard Marks for some time. So like Kaushik mentioned, I'm a sophomore at Harvard. My question really just stems from, I'm just kind of curious, after Oaktree was acquired by Brookfield, you know, even how that might have changed, you know, the work you're doing or the approach or the culture. And really, you know, how, you know, two big firms, you know, able to come together like that, how that might have affected the work you're doing, or if it didn't.
Yeah, so they haven't fully acquired us. They own us just over 60%. Look, I think what Brookfield was looking for was a credit partner. And when you think about these businesses, when you think about intellectual capital businesses like asset managers, there's two ways to do it. Either you decide to build it, or you buy it, right? And so I think the cost benefit analysis probably for Brookfield was, here's an established global business. It's complementary to what we do at Brookfield, and so that's why the transaction made sense. And I'd say it hasn't really changed how I go day to day. And I think for the most part, you know, I think Brookfield said that we bought a good business, great brand. Why should we change anything, right? And so I think we're just continuing to do what we're doing. There's synergies and there's opportunities for us to kind of take the two together and be more powerful in some areas, and that's what we're doing together.
Yeah, it's a huge, you know, a huge meeting of power minds, right? I think it's an amazing platform, a great platform, you know, before, great program after. So a few more questions that came in. Folks really want to know, and I'm sure some are a little shy to ask, so I will ask on your behalf. So what are you looking for in candidates, Milwood, right? So people want to work for Oaktree, right? It's, you know, the top name in a credit distress space. It's, you know, incredibly challenging to break in. It's also, you know, equally, challenging to kind of stay through and become senior there. So what are you looking for in candidates? And then maybe second, what makes people successful once they're there, you know, at the associate, VP, director level, so on?
Yeah, so I think we're probably looking for the same that everyone's looking for. We're looking for someone who's passionate. First of all, you got to be passionate about this business, and you exhibit that passion either through your academic, you know, preparation, your technical preparation through books and the like, and generally, and look, I think everybody, but I say generally, we're looking for good people. Right? Because good people sort of keep a good culture. And so it's kind of funny, like when we send emails, we say hi. And so when I got to Oaktree, I was like, why does everyone say hi in the email, right? Like it's kind of weird. It was kind of weird at first. And what it is it's basically we don't have any what I would call people who aren't just good people. And if you've got good people and good minds together, you create a good culture. And I think it's an exciting and fun place to work, right? It's like, I like talking to the people in my firm. You know, it's not like when such and such calls, I'm looking at, oh gosh, wondering what they want, you know, which you can get that in some places. And that's why I say you also want to go in an environment where you can be you and you feel most comfortable. And look, I think we're patient people. We're patient because cycles come and go, and you have to be patient. Your sort of disposition, you have to be a patient person. I think those are probably the big traits that when I'm hiring, that's what I'm looking for. I don't want everyone to be same background. You know, if you look at my team, my specific team, no one's the same. They're all different. And the more different all of you are, the better. That's how you get to a better outcome and a better decision if you've got differences on your team. And I'd say, look, in terms of success in getting to, you got to be patient, okay? Because not everything that you think should happen to you will happen to you on the timeline you think it should happen, right? So you got to be patient. You've got to be focused about, you know, what it is you're doing, right? You've got to stay focused. Because look, the reality of it is there aren't a ton of seats, but there are a lot of people who want those seats. So then the other question is, well, how do you get it? And I say, just be different, be unique. And make sure you practice your story, right? Don't just assume because I have a resume that your story, you know, sounds good. You've got to practice that story. Take your friend, take your parent, and practice what it is you want to say and what you want to get, you know, in an interview, because you got 30 minutes to sort of get it right. And that's what you don't see a lot of, right? There's not a lot of preparation before me. If you're interested in these firms, read their 10K, know their business. Like I always showed up at a meeting, and one of the things that was interesting at an investment banking management presentation, most people didn't read the 10K. It's factual. It's a great document. Read the 10K. If you're interested in Blackstone, read the 10K. If you're interested in Goldman Sachs, read their 10K. If you're interested in whoever it is, read their public filing. Know who they are, know what they're good at, know their businesses. If you're interested in private credit, read about private credit. You know, don't just have an interest in it, but like understand. There's books out there now on private credit. Talk to your alumni. Alumni are big. You know, Harvard is a big, you know, Harvard's big. You know, Georgetown's big. There are a lot of folks on Wall Street. And the beauty of talking to alumni is you don't have to say anything other than, hi, I'm such and such. I'm at your school. Tell me about your career. And that's all you have to say. Because people love to tell you, you know, about themselves. And then they're going to say at the end, oh, I really like Brent. And you didn't even say anything. So leverage your alumni network and don't be afraid to reach out to people. Don't be afraid of a no. Okay, there are going to be people who literally tell you, I don't have time. That's okay. You know, I get emails from people all the time. And I will reply to your email eventually. And if I don't reply, resend it. Say, hey, Milwood, I know the replies is usually after someone say, hey, Milwood, I know you're busy, but, you know, would love to get on your calendar for 10, 15 minutes. I don't mind giving someone 10 to 15 minutes. In fact, every week I block out time to just 10, 15 minutes, because that may change that person's perspective, that may alter their path. And so if you're interested in talking to someone, don't be afraid to reach out to them. If they don't want to talk to you, they just won't reply. You didn't lose anything.
I totally agree. That was amazing advice. I think a couple things I'll just kind of hone in on for all the students, and we'll get to Kim's question in a second, is number one, the alumni network. I think having now, you know, been at 30, 40 universities and partner up with them, that is the number one least utilized, as an underutilized tool I've found across the board. And that's related to the point Bill was making, is that when we ask students that, why are you not using, because that's a warm, right? It's much better than a cold intro. And then they say, hey, I'm afraid of rejections, was Milwood's second point. And then we're like, guys, if you send 100 emails, 70% of them by definition will not respond. Like but look at the upside, 30% of them responded, you got 30 new contacts. So it's sort of like just getting yourself in that mindset and being afraid to kind of unafraid to do that. I mean, I could not agree with you more, Milwood, on that point. Let's keep going. I think some of these questions, that's great advice. Kim Lee, you're up. You're next.
Hi, Milwood. Thank you for us.
How are you?
Columbia. I'm majoring in financial economics. I'll actually be starting as an analyst at Oak Hill Advisors in private.
Alan Schrager. You know Alan Schrager? Did you meet Alan Schrager?
No, I did not.
Oh,
But
okay. Good firm. I know those people.
I met you if I see you.
Yeah. You can say my name.
But I've been interested in distressed credit for a while and know that it goes hand in hand with restructuring and a lot of legal expertise. So I was wondering if you have any advice for someone who's like fresh out of college. I don't have a restructuring banking background and I don't have a JD. If that's necessary to transition into like a pure distressed investing role, or if it's
I don't think look, so by the way, there are a lot of like laws in distress, but that's the beauty of hiring lawyers alongside you, right? They can add that value immediately and we pay for that. There's a book called, I'm looking at my library here. I think it's called Distress Debt Analysis by
Moyer.
Yes. Okay. There you go. So you're ahead of the game. Tim, you're ahead of the game. If you read that book, you'll be ahead of 99.9% of the people who started out in distress alongside you. You'll automatically be smarter. And then there's another book that's pretty good. You may know. It's called High Yield Bonds by Barnhill, Maxwell, and Shankman. Great, just like basic overview book of high yield bonds and how it all started. And so the beauty is you can replicate my knowledge base to a large extent through books. Where you won't be able to replicate it is through transactions and situation and behavioral stuff. But the reality of it is, instinctually, you'll be just as good at it because you'll have the confidence, because you have the technical knowledge, and you're not spending time on that. You're just spending time on technique. And so I would encourage all of you to read a book or text around what it is you're interested in, and you can gather. There's another book by Bruce Wasserstein called The Big Deal. It's a great overview of just Wall Street, and it provides an interesting perspective on how Sears, kind of got Goldman Sachs started through commercial paper and some of the interesting stories about it. And so don't be afraid to grab a nonfiction book on Wall Street and use that as a competitive advantage. I don't know if that answered your question, Kim, but that's my.
Really.
So I
had to go get a JD or something. I
don't think. Look. I mean, the reality of it is, when I was a freshman in college and I took political science, I could fall asleep in that class and wake up and we're still talking about the same thing. So I knew I wasn't gonna I was gonna be a lawyer when I was a freshman. I was like, okay, I can't do that because I'm like, I can't stay up in the class. And so I switched to accounting. So, if you want to be a lawyer, you should be a lawyer. If you want to be a distressed investor, then hire a good lawyer.
Excellent life advice, guys. So exactly, focus on what distilling that, right? Focus on what you're good at, be the best at that, and then anything you think is a weakness, just figure out a way to kind of be resourceful around that, right? So I think Bill, great point. A couple things. I think what makes someone successful once they're answered like getting into Oaktree, like what do you think people there and then helps them succeed throughout their career? Like from the analyst, a lot of us here on the call, and then some of us on the call are associate principal, and then to be a senior leader like yourself. Maybe give us tips on, give people tips on career success.
Yeah. So a couple tips, and I think this, by the way, wherever you're going to go, I think this works. Don't be afraid to say, I don't know. Like one of the worst things you can do is say you know and you don't really know. Or if someone's giving you a path or a process to do and you say, yeah, and they say, do you understand what I'm saying? You say, yeah, when you really don't. Like early on in your career, it's okay to say, I don't know. Can we go through that again, et cetera, et cetera. In a lot of these firms, your first 6 to 12 months of how passionate, how driven, how hard you work will define you for several years, right? And so when you get that opportunity, seize it, try to be your best, and just remember, and this is advice I got when I was applying to Wall Street jobs, they said, look, your first year can make or break you in terms of your trajectory, right? And so, take that first year very, very serious, very serious. Ask questions. If you're wrong, it's okay. Like you can't bat 1,000. But the problem is some people are just afraid to be wrong, that they end up making 3 times the mistakes they would have made if they just admitted they were wrong on the first try. So and so humility goes a long way in these seats. Being a team person is as you get more and more senior, that becomes more and more important, right? I had one manager come to me and say, Miller, this person's not connecting with me. And I said, because you want them to do it your way. Like, you've got to let people get to the same answer the way they feel most comfortable getting to. There are multiple ways to get to the answer. And so if you're in an environment where there's not a lot of flexibility and that bothers you, get out of that environment, because it'll suffocate you. So I don't know if that's.
Yeah, no, that's helpful. I mean, kind of what you're saying. Also, a lot of takeaways, but also, like, don't put too much pressure on yourself, right? You have a lot of, I mean, by virtue of this platform, right? I think, we're at all these top schools, but I think, you don't consume what by other people are doing career, and so on and so forth. There's going to be like a natural line, and you're going to find the things that I think you're good at. So I think that's fair. Well, in the interest of time, we'll be really mindful of your time, Milwood. I think we had on over 100 people on here, so kind of multiplier effect. I think you've been able to impact so many people. I think as they look at their career, distressed, etc. Last thing I'll leave you with is any parting wisdom, advice to our group here. These are all extremely eager, extremely sort of high performing students and early professionals. So we'll leave it to you for the last word.
Yeah, look, I would say there's always an aberration to the statistics. So success is not just because you had a 4.0 and just because you went to X, Y, and Z school. A lot of it has to do with self-confidence, perseverance, and your attitude. And I can tell you, I've been on Wall Street now 20 years, and I've seen some really smart people not do so well because of those 3 things that they didn't have. And so, I would encourage you, it's not necessarily just about, how smart you are. There are a lot of other reasons why you can be successful. And let me tell you, just by the fact of everyone being on this call, you're already demonstrating success, right? Because you were curious enough during lunch, or at least it's my lunch here in New York, to dial into this and say, let me see what this guy has to say. I don't know this guy, and so you committed an hour of your time where you could have done something else. That shows success right there. So, don't give yourself, too rough of a time. Like Kaushik said, take your time. You'll get there. And look,
obviously, Mill was an amazing resource. So, and look, you've spoken in other places, and I think the other great resource, guys, is Howard. Howard puts out memos like every other week on these types of things. So Howard Marks' memo, if you guys aren't sort of subscribed, I would really go in and do that sort of that diligence, especially for interviewing at Oaktree, right? Make sure you've read at least like 10 of those memos before. So all us guys, thank you so much, everyone, for joining, and most of all, thank you, Milwood, for the public platform. We're so excited to have Oaktree on, and look forward to future stuff, and hopefully you'll be hiring more elevated people at Oaktree, and we can talk about it. But anyway,
look forward to it. Yeah. Thanks for your time.
Thanks, guys. Bye.
Have a good weekend, everybody. Stay safe.
Thank you.
That's right. Thanks, guys. Bye.